Hey everyone, welcome back. My name is Kenny Robinson. If you're new to my channel, I'm a full-time investor and I invest in a variety of different asset classes and different investments. In this video, I want to show you how I construct a passive income portfolio and the things that I think about as I construct it. Things like, how do I hedge against the strong dollar? How do I hedge against a rising rate environment? How do I ensure that my income will continue to flow through a crash or recession? In this video, we're going to cover all that. We're going to hop in my computer here and I'll show you exactly how I do that. All right, let's get started. All right, just like that, we're in my computer. So on your screen, you should see something titled Income Portfolio Securities List. And these are some of the investments, whether they're individual stocks, ETFs, or mutual funds. These are some of the things that I put in my passive income portfolio here and there, depending on what type of passive income portfolio I'm trying to build. So again, this isn't all of the different investments I use, and I don't use these all exclusively within the same portfolio, but some of them you've probably heard of. Realty Income, the monthly dividend company, famous for monthly income. It also just became a dividend aristocrat, which is really, really cool. It's one of my favorite stocks. In fact, I have a Realty Income brand new hat that I want to do a giveaway at 5,000 subscribers. I really appreciate the activity and the growth on my channel. So far, it's been great. So I really appreciate it. So I want to do a live stream and a giveaway at 5,000 subscribers. So definitely look forward to that. And then let's see, more updates, remind me later, of course. All right, the Southern Company, massive utility giant in the southeastern US, really nice yield. The York Water Company is a water utility. They have been paying dividends since James Madison was president, if you can believe it or not. And their first pipe system was literally logs that were bored out, hollowed out to pass the water along to the municipality. So they've been paying dividends for over 200 years, which is really, really cool. As far as exchange traded funds, the ones that I like, a lot of the ones that I like, ProShares Dividend Aristocrats, NOBL. And if you're not sure what a dividend aristocrat is, it's a S&P 500 large cap company that has paid dividends consistently each year and risen their dividends consistently each year for a minimum of 25 years or more. So every year, even through times like the tech crash in 2008, not only did they pay a dividend, but they also raised their dividend. So this is really nice because it's an ETF that does well through downturns because you know it's going to cash flow. And it's also not that tech heavy. And so during the tech crash, it actually made money. It posted positive gains. So that's a really nice defensive income type of investment, full of shareholder friendly companies. The next one is a very interesting play. I really like this one lately where we're at in the markets. Everything is high priced, right? When you buy US equities today, you're paying a premium for them. You know, there's no way around that, except for through this Oppenheimer S&P Ultra Dividend Revenue, RDIV. And so instead of purchasing a market cap weighted ETF, dividend ETF, what this does is it purchases value-based companies and not based on their market cap, but based on their top line revenue. So you're actually buying companies that are valued pretty cheaply, but you're getting the best revenue, the best companies that have the strongest revenue. So pretty high dividends. This is a really interesting play for people who are nervous about buying at the top. This is a really interesting play and it's had some solid performance. Yield Shares High Income ETF, triple YYYY. It's a fund of funds is what they call it, and it's actually full of closed-end funds. It's probably the most riskiest one out of all of these. You're going to see some volatility. It does use leverage, but I feel like it has a place in most income portfolios, just not a lot because it is risky, but again, it does have that nice monthly high yield. The next one is Wisdom Tree US Small Cap Dividend, DES. The reason why I like this one is domestic small caps are a great way to hedge against the strong dollar. Because think about it, US small cap companies generally receive a majority of their revenue, of their income in US dollars, right, domestically, because they're not doing a lot of global business. So usually small caps are a great hedge against the strong dollar. So, you know, and if you have some small cap dividends in your portfolio, that's a nice hedge against a strong dollar. The next one is the mid cap dividend. People tend to not think about small caps and mid caps when it comes to dividends, but it's really nice to have that market cap diversification in a very well diversified income portfolio. The next one is emerging markets high dividend. Not another place where investors traditionally go for dividends, but it's always nice to have geographical exposure and diversification within your income portfolio. The next one is another one I really like is the Vanguard International High Dividend. This is mostly developed markets, large caps, but again, you're looking for that geographical diversification. Some mutual funds I like for passive income portfolios is the Principal Global Diversified Income Fund. Not only does this pay monthly, but it has about 6,000 different holdings. And it's not throwing spaghetti at the wall to see what sticks. You know, it's not that type of diversification where just make sure you have a little bit of everything. You want strategic diversification. So this has a lot of different little things that you really won't find much of in the ETFs above. And it's really nice because it not only does you get really nice capital appreciation, but really what we're after is the yield, and it has really nice yield lately. The next one is the Oppenheimer Steel Path MLP. Anyone that's familiar with the energy industry understands that oil and natural gas and propane and things like that is normally transferred by truck, pipeline, and ship. And so what this does is it owns a lot of those transfer companies like all the pipelines across North America, some ships, rail, things like that. So anywhere where oil needs to be crude oil or any sort of energy needs to be transferred from the drillers to the retailers to the refineries, essentially, right? So it acts as a toll booth. And so this is really nice because you get exposure to MLPs without the K1 filing because you're buying it through a mutual fund. And this currently yields, I believe, around 10%. Again, you're going to see some volatility, so just be aware of that. That you need a little bit of energy in the portfolio, but not a ton. It is great, but keep in mind it is volatile. Although just a year or two ago was a really nice time to buy as crude oil was rock bottom. Oppenheimer Senior Floating Rate. This is a nice hedge against our rising rate environment. Traditionally, when you buy bonds in a rising rate environment, they get downward pressure put on those bonds because new bonds are issued at higher rates, which are more desirable. So investors sell their current bonds and buy those at a higher rate, so the value of those bonds go down, right? And so if you're someone that doesn't like to see your portfolio dip, even if you're holding those bonds to maturity, the senior floating rate fund generally rises in yield as rates go up, right? These are senior bank loans to really nice large cap companies, and so that's something that you can put in your portfolio to hedge against rising rates. And really the rules for sustainable income stream from a publicly traded portfolio, again, there's no private investments in this, is you want diversification. And what I mean by that is you want geographical diversification. You don't only want to invest in your home country or in the US or wherever you're located. You want market cap diversification. Like you see here, we have small, mid, large, all sorts of mega caps, things like that. You also want sector diversification. I know a lot of people that they're real estate investors that are very successful at what they do, but 2008 were famine years for them, things like that. Or, if you're an oil investor in 2014 when the price of oil crashed, you weren't sitting very pretty at that point in time. So all of these are great investments, but no single investment is the right way to go. You need a mix, and so you need several different sectors. And then the final one is you want diversification among the financial instruments. What do I mean by that? Well, you want some stocks in there, and you want some convertibles, you want some preferreds, you want some bonds, you want some senior floating rate, bank loan type things in there. You want a mix of financial instruments for a well-rounded passive income portfolio. The second thing this is actually even a larger mistake that I see rather than people not diversifying is, okay, so they set up their income portfolio and say it's even diversified, but then what they do is say their income portfolio produces 6% annually. And so every year they're just squeezing the hell out of that portfolio and taking every penny of income, and they're living their life on that. Well, the problem comes when over the years inflation creeps up its ugly head, 3% per year, the cost of goods and services rising over time, and so their income stream actually becomes less and less powerful among what they purchase because of inflation. The second thing that happens is during a down year like 2008, for instance, they're used to that 6%. Well, a lot of times these funds will either lower or stop paying, hopefully not, but sometimes they will. So what you want to do is when you get your yield, pay your taxes on it, whether it's qualified dividends or ordinary income, or maybe you have some munis that are tax-free. What you want to do is after you pay your taxes on your income stream, you want to reinvest a minimum of 10% of that, right? So many times that's just a few $100s. If you have a $100,000 portfolio, 6% yield, that's $6,000 per year. Let's just say 20% for taxes. So after that, what do you have? 4,800 bucks maybe. So you take into account, and then maybe reinvest $500 of that. So not only is your portfolio going to grow, it's going to help fight inflation. And if, for example, we have another 2008 or a massive downturn, the amount of yield you'll be getting will be much more than you originally started with, so you can keep your original yield stream going through the crashes and the recession, right? Don't try to squeeze every penny of yield you can out of your portfolio each year. Reinvest some to grow it and get a nice cushion so you don't have to step down your lifestyle in years like 2008. I know a lot of people in 2008 that had to sell a lot of stuff, really lower their consumption just because they were going full gas, pedal to the metal on their investments and taking every penny of income. So it's definitely important to reinvest some so you don't have to deal with that. So how do we build a portfolio incorporating some of these and making sure that we're diversified: geographical, market, capitalization, sector, and financial instrument? So let's pop over to our portfolio analytics. So what we can do is we can start typing things in. So let's type in Noble, our dividend aristocrats. Let's see here. Let's just do 10% in that. And then let's take some Oppenheimer senior floating rate. I believe this is. And you want to make sure you get the right ticker in there for your account. So you'll have to do some research on that. Let's get some realty income in there, 10%. We'll just put 10 in all these to start with. Let's get some principal in there, 10%. Okay. Wisdom tree. Let's get some small cap in there. Let's get some oil pipelines in there. Again, with these mutual funds, you want to make sure you buy the right share class if you're going to place those in your portfolio. Let's get some international large cap, 10%. Let's get some revenue weighted dividend stocks. RDIV, the Oppenheimer one, let's do 10% in that. And then let's do another 10 in emerging. And what I'd like to do, I want a little bit more fixed income type, or I guess not fixed income, but bond equivalent. So, okay, then we want to go generate analysis, and then we'll take a look at our portfolio here. Okay, so bonds were about 25% of the portfolio, a little bit of cash in there. Non-US stocks, a decent amount, just over 20%. And US stocks is the lion's share at about half the portfolio. And then this other, usually this program, it's has trouble analyzing some holdings within some of the funds, so it just puts it in other. And so it looks like our 12-month portfolio yield is 4.5 since 2006. Here's the appreciation performance of it. And the reason it only goes back to 2016 is that's the youngest investment within this portfolio. So if we were to take out the youngest, maybe it would go back a few more years. What's really nice is it shows you the equity style diversification. We do have a lot of large value. That's mostly Noble and RDIV in there, but then we have a blend and we have some growth. Again, this is an income portfolio, so we're not really looking for a lot of growth, but we'll take some if it comes our way. And then the fixed income style, this is where this program gets a little bit wonky because it's not sure how to analyze those bank loans in the senior floating rate. So let's take a look at. And also, it's also really tough to discern the alpha and beta of these very diversified portfolios. So this is a really important thing to look at over here is you want sector diversification, right? Something we mentioned. So here we have our portfolio, and it's really damn near balanced in between cyclical, defensive, and sensitive. So we have just under 40% in the sensitive. Most of that's going to be our energy, as we have those pipelines, things like that. Cyclical, we're pretty heavy in financial services and real estate. Most of the real estate will come from the Principal Global Diversified, and we have realty income in there as well, so just over 40%. And then we have some defensive, just under 20. So as you can see, it's a really well-diversified portfolio. And you say, okay, well, we want to bump up our yield from 4.5. Let's try to get 5. So all we do is drop down the thing, and we turn up the risk knob. So let's see, what should we add? Let's take away that extra 10% I added, and then let's add some YYY in there, that closed-end fund of funds. That's going to make it a little bit more risky, but it's going to juice up the returns a little bit. Let's see, 4.5 to what? 4.91%. Okay, so we juiced up our yield a little bit to 4.91%. Let's take a look at what that did to so it didn't change it too much. We're a little bit light in healthcare, so maybe we could add like a healthcare REIT like LTC or Welltower. Although we have to be careful on the amount of real estate that we add. So this is what's really cool about, you know, really typing in your portfolio into an analyzer like this, is you're able to make sure that you're geographically diversified, your sector diversified. You can check out your projected yield, and you can really go over and make sure that you're well diversified. And really, when you do these types of things, when downturns come, as long as you're well diversified and you've reinvested some of your yield, you really should be able to weather the storm fairly easily. So with that being said, if you have any questions, a lot of the questions can be answered within the description below. I have a lot of different links for different things. If you're interested in more videos like this, let me know. If you have questions, comments, concerns, place them in the comment section below. And if you're new to my channel and you haven't subscribed, definitely consider subscribing. And again, at 5,000 subscribers, I'm going to be giving away a Realty Income hat, and I'll be doing a live stream. So with that being said, this will conclude this video. Thank you for stopping by, and we'll see you next time. There goes a sight from my soul.